If used correctly, Fibonacci retracement levels are the most powerful tool when it comes to doing your technical analysis, right? And it's really one of the only tools where you see institutional traders and retail traders both unanimously agree that it's indispensable when it comes to doing your analysis process. The only problem is retailers, they miss out on three key things. One, they don't know the right time frames to draw them on. Two, they get really confused on where to place the swings. And three, they oftentimes have analysis paralysis when it comes to the levels. All right, so today I'm going to be basically showing you guys exactly how a lot of the institutional guys use Fibonacci retracement levels. And I actually have an amazing example where there was a trader that made $600 million and their entries came from Fibonacci's. Let's roll the intro. My name is Cleveland and I worked as a professional trader and analyst for 6 years. And now I'm here to bring you my daily insights on business, capital markets, finance, and more. Enjoy the video and welcome to the channel. So let's get things started. Today we're gonna be looking into how the institutional guys utilize Fibonacci because it's not often discussed, right? And if you guys are new to the channel, I like to look at trading from a hierarchical point of view. Usually on the YouTubes, right, most people are just really in the nitty gritty about the technicals or, talking specifically about, what this particular currency are doing. But it's good to have a solid foundation and understanding because that gives you more confidence in your trading ability. All right, so if this video helps you out, make sure you guys like and subscribe. All right, so here, let's kind of do away with some of the conspiratorial things dealing with Fibonacci. I don't like subjectivity because I could say one thing and then you guys can hear someone say something else and now you have this indecision. Let's talk about the objective function of using Fibonacci retracement levels. And the amazing thing is when the institutional guys trade using Fibonacci, that's basically as far as they go. Maybe some firms will start to have certain ideas about certain levels and things of that sort, but I just already don't want to get you guys into that idea like that's how this video is going to be. We're going to be really talking about here what's called marketplace dynamics, because what happens is anytime you have parabolic moves where you're trying to identify certain swing lows and swing highs and then trying to quantify how big of a retracement those swings are going to have or how big of an extension those swings are going to have, we're really talking about how buyers or sellers are interacting and really what tolerance they have in terms of drawdown limitations. Okay, it's quite complex, but don't worry, we'll look at some charts here in just a second. First thing I want to mention though is this entire idea of how we're going to be utilizing Fibonacci or how institutional guys utilize Fibonacci is going to be based on event-driven hedge fund strategies. These are the firms that use Fibonacci the most. If you guys don't really understand what that is, make sure you guys sub because we basically trade that style strategy. Event-driven hedge funds, which were last year, by the way, the most profitable hedge funds in the entire industry. Here's a screenshot of the top event-driven hedge funds last year and their returns with hundreds of millions of dollars under assets. No other firms did this well. Not fixed income, not emerging markets, not equities. These firms perform really well. And these are the firms that use Fibonacci. And it's for this one reason, right? Event-driven trading strategies happen, right, because market participants have identified a parabolic move. The example we're going to use and the firm that I'm going to be talking about a little bit later on is an oil trade that was done right around COVID. I don't know if you guys remember, but oil dropped to negative $40 a barrel. And then of course, rocket shipped to where we are today, right? But at the end of the day, there was a really massive arbitrage opportunity to take advantage of that cataclysm of an oil sell-off. And the way they got their entries was using fibs, and they also did a little bit of FX trading in that situation. So let's take a look real quick at oil markets and start to talk about how they were able to identify with fibs where they wanted to start interacting. So initially, we all know that people assumed that since we were going to get a slowdown in transportation, global markets started to tank oil prices because there was going to be a dry up of demand. And that's when we had this initial massive sell-off here. But it really was overdone. And the oil suppliers really started to tighten up their production, which really stricken the oil markets to have this type of collapse. But what you guys can notice here, this is a weekly, it was very short-lived, right? We'll go to the daily, maybe we'll get a little bit more clarity there so you guys can see. We'll have to go back again, this was around March 2020, but you guys can see it was really just one trading day where you saw this massive collapse here. But how can you really draw Fibonacci on this, or where would you start? We're going to be using our fibs where they were using them, which is on the Canadian dollar, because anybody that knows anything about the Canadian dollar, you'll understand that the Canadian dollars, their gross domestic product, is heavily skewed by oil because that is really their commodity currency, really. So let's head over to the Canadian dollar and we'll actually look at the Canadian dollar index, which again, most large institutions are using currency indexes. Retail traders only think about the USD index, but you have to have your indexes for all the currencies. We have a link. The indexes are free. The link is in the bio below. So you can see the same collapse here, right? Take a look at this. The same collapse that we have, on oil happened at the exact same time here with the Canadian dollar. So there we get some correlation. Some people don't like correlation. Some traders do, whatever. This is where they drew their fib up, from the high to the low, right? Now, here's the difference. When a retail trader draws up a fib, they're not really going through some logical process as to why they want the fib at this high and at this low. It's really just about what looks good. That's not how institutional guys do this. In this example, maybe it's a little obvious that you'll draw it from the high to the low, right? But if we were to go to the euro, for example, right, and recently there was great opportunities to basically be shorting the euro, it might get a little bit confusing. And the only reason I know this is because the euro has been just an amazing trading opportunity as of late. But there was a big trading opportunity, a big event risk opportunity, right? And let's say, is this your high here, right? And would this be your low, right? Or would you say, no, Cleveland, actually, I want this to be my high and maybe here's your low, right? Or would you say, no, Cleveland, I want this to be my high here and here's my low, right? So there's many options, as you guys understand, right? And then also, again, we haven't even touched on the fact that we're not even talking about the actual time frame that we would draw them on and what levels we should be looking at. The way institutional guys draw up their fib, especially hedge funds that are more skewed to trade event risk strategies, they want to encompass the entire event, right? So when the event started to when markets are now slowing down in terms of how they're perceiving that particular event, right? Markets don't just flood in one direction forever, right? If something negative happens, usually there's this impulse leg or parabolic move. Markets then start to slow down, and then subsequently after that, markets start to think a little bit as to how they want to continue to approach that particular trading opportunity, right? I was on a weekly. I want to show you guys here what we're looking like. So if we go back to the USD CAD, what you guys will notice is, again, right around the time where we got that initial massive impulse move where the USD Canadian dollar, we had this massive run up. This was the US dollar getting extremely strong during the time of COVID. We then, though, ended up having this massive sell-off. This is where they started to draw up their fibs, from this low all the way up here to this high, right? And so what you notice right around that 38.2, you started to get some consolidation. We have now encompassed the entire event of the particular move. We are now really focused on the consolidated high. And that is the point at which most of the institutional guys are really trying to quantify what they're going to do next. Is this move going to continue to break out where we're going to see markets again maybe sell off here, pretty deep retracement, but then just eventually bang to the upside? Or are we going to have this pullback? And as we know, with COVID, the recovery was way faster than what anyone could expect it. But specifically when it came to oil markets, there was something interesting that happened in the last week of May. So right here, you guys can see May 21st, we got our breakout of this entire consolidated range here. It might look a little bit better here on the weekly if you guys can see it. Let's pull over and take a look. So you guys can notice this nice little consolidated low was an amazing trading opportunity if you felt like, hey, the event that happened, oil markets massively imploding to the upside, the US dollar massively exploding to the upside. Well, since the recovery is going on, these markets can't stay stable at these price areas. They're tying the fundamentals with the technicals, right? And this is what I've always tried to preach on the channel for so long. People think I'm just fundamental, but no, you have to do both, right? And so what's awesome is, again, if I show you guys here what we see in crude oil, what you guys will notice is that exact same week, that's when we had a pretty dramatic turnaround when it came to oil markets. All right, let's pull over here. And boom, there you go, right? So right there, you see there was this initial break to the upside. Now, it might look small now, but these guys were buying up oil down here in these lows. You guys can see we're in the negative territory. And they really put on size once they started to see markets break outside of this level here in terms of market consolidation. And I'll put the link below in terms of the entire documented story of the entire trade. It's like the Essex boys, and they made, again, it was like 600 million bucks in just a few days. But when they got this initial break of this particular high, that's when their trade really started to run. And you can even see that play out extremely well here in the currency markets, where, again, right around that time, here you go, 15th, we got this initial sell side, little retest, but markets never came back, right? And so when the institutional guys are putting their Fibonacci on, one, they're usually never throwing anything on there below the 4-hour time frame. It's usually the daily and the weekly, rarely the monthly, right? You're going to get some pretty awesome trading opportunities on the daily and the weekly time frame, right? That's one. Two, when they're drawing their swing low and their swing high, they're really trying to encompass the entirety of the event that they're trying to trade. And again, we trade an event risk trading strategy. We've been doing it for about 6 years. We've called it economic divergence, but internally we're really slowly starting to use that language because it's starting to make more sense to our traders. So we're just basically getting the semantics right, but it's the same strategy, right? The reason I wanted to show you guys that euro opportunity is because the euro was, again, just a ridiculous position where, yeah, sure, if you really weren't tied in on your fundamentals, you may have been a little bit confused, but take a look, right? This is when Russia first started to invade Ukraine, where it really started to hit the tabloids around February, first week of February, second early week of February. And then guess what happened? By the time that we got to somewhere around mid-March, early March, things slowly started to calm down and the conversation stopped, right? And so you did have a retracement, but we now have the full event, the whole Russian invasion, which again did start a little bit before. They were talking about invading Ukraine back in December, but we have the real media buzz about it right here, from this high to this low, right? We should be focused on the event, because now that we're focused on the event, all the price action subsequent to the event tells the story as to how the market participants are trading that particular event. And as you guys can notice, yes, they let markets run back up and retest that structural level here, but this was really because the media stopped talking about it. It wasn't really that serious anymore. And then boom, out of nowhere, Putin started launching long-range missiles from Russia into Ukraine. And then you just had a massive market spill off. And now you guys can see, ever since, there's actually been some pretty crazy updates. Apparently one of Vladimir Putin's, I guess he was like his psychiatrist or psychologist, his daughter got blown up in a car bomb that was meant for him. And apparently it's just really negative. And now, let's see, Euro USD below parity at this point. We're at 99, right? So we just hit below parity today, right? So again, trading that particular event, it helps you understand how the market participants are looking at that particular situation. Think about it. If this thing turned around and traded all the way back up to the high, that's basically the market saying, hey, we don't care about that anymore. Whatever economics are coming out or whatever new news is coming out about the euro, that's what we're paying attention to. No, not at all. That's not how they're looking at this particular situation. It's still priced in. And you guys might start hearing that language if you continue to read your fundamental articles. We actually have an economic research report that we're about to drop once a week to kind of help you guys understand the world economy and how not only the economics are playing out, but how the economics tied in with the capital markets are playing out. Because you can have an understanding of what's happening or what the CPI is of Yugoslavia, but if we can't really correlate that back to the actual currency markets, then it's really frivolous information. So a lot of times people try to learn fundamentals and learn different data points as to what's happening in an economy, but that information may not be relevant to markets. And so that research report should help you guys there for sure. All right. So I hope this helps in terms of how the institutional guys take a look at Fibonacci, right? They like to understand what's happening on the actual events. They don't care so much about the levels, whether it's the 38.2, the 50% retracement level, the 61.8, they're not too specific about where they're trading it from. All that's really happening is the market's telling you a story as to how much of a retracement or how sizable of a pullback they're allowing to happen, even though this particular event just played out. And there are a couple other factors too with this, right? One thing being how fast markets fall, the momentum of the actual swing that you're really capturing, that's important. If it happens in just 3 days, markets are going to change a little bit differently. This is the marketplace dynamics that I'm talking about, right? If it happens over the span of 3 months and you have this sell off, well then, yeah, how that retracement plays out, again, is going to be changing. And so we have all this documented inside of Top Trader University. If you guys want to learn our event risk strategy, our economic divergence strategy that we've been talking about for years, make sure you guys fill out the info below, get on a call with one of our senior traders traders. All of our senior traders are managing at least 100 grand. So that way, you know, they have skin in the game and that they've been trading these strategies as well for years, and they can kind of tell you a little bit about them. You can ask some questions, whatever. All right, so that's about it. All right, if you guys have any questions, let me know. We're gonna be doing a little bit more deep dives as to how to understand the fibs. I'm gonna be doing a full video on fibs and like a fib tutorial, like a master class on fibs from basic to pro, so to speak, on the channel sometime in September. So make sure you guys sub and trade safe. All right, peace out.